Welcome to Founderline, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us today. It is great to have you all with us. Founderline is all about helping people who are interested in startups. So whether you're somebody who's thinking about starting a company and you have some questions about how to get your company off the ground, or maybe you've started a company and you're encountering a situation that you need some help with, or you could be an employee who's thinking about joining a startup and you want to ask some questions before you decide to accept an offer. In any of those cases, we'd love to try and help you out today. This is a live show, so you have the opportunity to contact us right now. You can do so by either emailing us your questions to help@founderline.com, or you can also tweet to us. Our Twitter handle is @Founderline. With that, let's get started. Our guest today is Mitch Zuckley, who is the global chairman and CEO of Oric. He's completed hundreds of financings and been through a bunch of IPOs and acquisitions with companies you've definitely heard of, like Nest Labs, eHarmony, Martha Stewart Living, Benchmark Capital, and Sequoia Capital. He's also an original sponsor of Founderline, and one of the reasons we're able to bring you this show every week. Mitch, welcome, and thanks for joining us today.
Joe, fabulous to be here.
It's always great to see you, and I really appreciate you taking the time. Before we dive into questions from the audience, I'd love to just spend a few minutes on your background and get you warmed up a little bit. So one of the things I love is your past at Bowdoin College. Yeah. So it's a long way from a liberal arts college on the East Coast in Maine to being chairman at a global law firm like Oric. Maybe walk us through the journey from college to how you ended up here at Oric.
Well, I'll be glad to. It's not a really direct path, but
they usually aren't.
Usually aren't. So look, I got out of college not really sure what I wanted to do, and very quickly determined that in some way I wanted to get involved with tech. Not because I've got great alacrity in tech, but because I thought it was one of the two most important factors that would probably influence business during my professional career, tech or energy. And I found my way to being a lawyer. As a guy who couldn't program, wasn't an EE, going to law school was a good path, to deal at least a glancing blow toward tech. And obviously, the most logical place to come was Silicon Valley. I was lucky to start at a little boutique called Venture Law Group that focused entirely on tech companies. We only did that work. We didn't do any litigation. 100% of what we did was corporate work for tech companies. And I was fortunate to start that around 1996. So a couple years of normalcy prior to the incredible boom of late 1999, 2000, and eventually, of course, the bubble burst of 2001.
Yeah.
All good experiences.
Which and VLG is where we originally met.
That's exactly right. We met at VLG with Jim Brock, and there was a fabulous group of folks that were there. One of your prior guests, Dave Hornick, was one of my closest colleagues in those early days, and many of my friends like Jason Lemkin, who I think also was a guest, was a colleague and a classmate of mine in law school. So fabulous group of people brought together at a really remarkable time. And it was a fabulous time to grow up as a lawyer. I mean, the opportunities to work on fast-paced growth companies were unparalleled. Never seen anything like that. Yep. Probably won't see anything like it again. But it was also good to go through the experience of that downturn, as well as the 2008 downturn. And one of the benefits of that was recognizing that a practice that was too focused on one industry probably wasn't sustainable either for the Valley or for an individual's practice.
Right.
So I stuck to the knitting of being a lawyer and enjoyed that a ton, and very quickly though determined that the tech business was going to become global, and in order to do the best service for clients, it was probably not to be best at a boutique. It was best at one that had global reach and had the benefit of litigators, not because necessarily your clients are going to have litigation, but it's really different to have great litigators 4 digits away as opposed to 7 digits away in terms of providing guidance, particularly when it's proactive, right?
Yeah.
And so that was an important choice, and ended up going to Oric because it was a strong transactional firm with a global platform. And eventually, like anybody who works in the tech space and spends time in board meetings, you get the bug to operate. You want to be part of a business and actually help make decisions. And we're like any other business. We've got interesting operational challenges. So it was great to walk the walk of helping to make some of those decisions rather than simply help make those decisions or help be a Sherpa suggesting where to go. It's nice to actually walk the walk yourself a bit. So we're a firm that's got more than 1,000 lawyers. We have 26 offices globally, about $900 million of revenue a year, and there's all kinds of challenges that any business has in terms of attracting, retaining, inspiring great people, in terms of thinking about what products you're delivering to customers, how do you deal with technology, how do you deliver products more efficiently, where do you want to be doing additional investment, where do you want to be pruning, how do you deal with currency risk, all that stuff. So
Wow.
the same stuff that any tech company deals with at scale, we do as a service business too.
That's great. So how much of your time do you get to spend on actually doing client work as opposed to running the firm?
That's a good question. It depends sort of day to day. But on balance, I'd say 25% of my time is spent doing client work and about 75% doing firm work. And the biggest change in my life, since doing this job, which I've been doing for about 2.5 years, is the amount of travel I have. So I'm probably spend half my time outside of Silicon Valley, or Silicon Valley / San Francisco. And of that time, probably half it's international and half it's in the East Coast.
Yeah, yeah. And when we used to do these shows with you calling in once in a while, like you're in Hong Kong, you're in Moscow, like who knows where Mitch is today, but we know it's the middle of the night somewhere.
It was always fun to call in, even if it was an inconvenient time.
Well, we decided to let you come during daylight hours.
Fabulous to do it. Good to be in the same time zone.
Yeah,
fabulous.
exactly.
Good to see you in person.
So every week I give this little speech about if you're a startup CEO, you're a founder, you want to have a great lawyer, not only because they're going to do your legal paperwork, but because they're one of your most trusted advisors. And a lot of people ask me, well, how is that true? So maybe walk us through the situations where it's not necessarily a legal issue that you're grappling with, but more a piece of advice or something. What situations can you or another really good lawyer be helpful in for a startup CEO?
It's a good question. And I think that there are 4 risks that every company's got. Right? Every startup's got technology risk, meaning does your product something that is unique technologically, and can you defend it if you need to?
Okay.
There's execution risk, meaning does this team have the ability to execute on its plan? Does it have the right people around it? Does it have the right people in the right jobs? There's market risk, meaning, well, will dogs eat the dog food? Will customers buy the product?
Yeah.
And there's finance risk. Can you raise the capital you need when you want to on the terms you want? And any good lawyer, and there's a lot of them in the Valley and a lot of them around the country, should be able to help with all 4 of those. And obviously each person's got their own skill set. Some people are fanatically good coders and they have a strong background in startups themselves. Others don't. We all bring something together to the mix, but any law firm should be able to help with those. And let's walk through a little bit on each.
Yeah.
So tech risk. Obviously, one of the key questions people always have to think about is, should I patent something? Should I not? How should I protect it? How do you make sure that the right IP is in the company? Some of that's simple, making sure that you've got executed agreements with everyone who's a consultant or an employee, making sure that they've got the right venue, that there's no confusion about any competing work people are doing at the same times for customers in the same space, who owns what. And if you mess that up, it's a big problem for a company. So there's a fair amount of very simple work, which I just consider housekeeping, which is routine, but if you don't do it, it's got a huge maintenance problem. It's a huge problem for you, right? And then there's strategic stuff around what do you invest in and when do you not invest. And someone who's familiar with the industry, familiar with the players in that industry, and can help you think about how cost effectively protect your business is a big deal. I'm not a patent lawyer, but part of my job as a corporate lawyer is to bring in the right resources. There are some companies which, for example, are big developments. If you look at something like RPX, which is something that a startup might subscribe to, it can help you defend situations against trolls. And it's a terrific company that people should pay attention to. They've got a very affordable product, and it's worth thinking about that. But that's an area where you really should get some legal advice. And I think that the one thing I would say, though, is usually when you go to a patent lawyer, it's a little bit like going to a gunfighter and asking, for advice. Well, a gunfight will probably break out. right?
Yep.
I think it's actually useful to use someone who's a consigliere at a more broad level to help decide when to bring those people in, and to think about resources, about how much to dedicate to them, because it doesn't make sense in every case to go overboard. And a lot of founders that we meet who have been doing stuff on their own, they might overinvest, I think, in tech. And they might, think I've got these patents, therefore I've got a valuable business, and I've spent, $200,000 to secure these patents, and they cover 14 things, and that's my business. And of course, that's 1/4 of the business.
Yeah, yeah.
So the second piece, execution. If you've been doing this like I have for 20 years, you know the Valley pretty well. You've got a roster of entrepreneurs that that you think are talented folks like you, that you've worked with before, of course. And part of what your job is to be a little bit of a matchmaker and think about who's gonna work well with one another, and to think about who's got the right skill sets for the right stage of company. Obviously, that's not something that lawyers know uniquely, but you have a chance to work with people, and they leave an impression, positive or negative, and oftentimes you can help put good folks together. And that's just something that you should think of as an important part of it. By the way, a more sophisticated piece of that in particular is advice around how to deal with a board. A lot of entrepreneurs don't know how to do that. They're not skilled at board presentations.
Absolutely.
They don't. They're not familiar with what you want to achieve in a board, what you don't want to achieve in a board, and having someone who can pay attention and really be there as your consigliere to watch that dynamic and make suggestions in a non-threatening way. It's a big value I think that lawyers can bring. The third, and probably most obvious, is the finance risk. There's both the technical side of what rights are you giving up in exchange for an investment,
right?
And there's the idea of, are you setting a template which is going to make it easier for investors to follow on to? But there's also the idea of who might be a good investor at this stage.
Yeah.
If you're, again, part of this job, an important part of what you do is understanding that ecosystem, knowing who's active in it, what sectors they're interested in, and frankly, which people might be able to, as investors, help add something that might not be part of what the team's got. If you, for example, there's a lot of hires that happened. Some VCs have got better Rolodexes than others in terms of how they can be helpful in terms of assembling a team. Some are really well connected with strategics and can help get those first customers. Some, by virtue of their reputation, make it easier to attract and retain people, frankly, and sometimes at a lower overall cost because there's a perception of quality that comes from their investment. And finally, there's some who are just fabulous at helping you work through the business issues. And then, the last piece of that is market risk. It's probably the area where I think lawyers are probably the least valuable in terms of adding help, but that's not to say they aren't. And there's a huge spectrum in terms of the business savvy that lawyers bring to the table. I think there's some that I think are absolutely fabulous and fabulous advisors who are really good at helping people do that. Others might not be, and it's up to the entrepreneur to kind of test that out. But I think that some domain experience and deep experience within a particular area allows you to recognize patterns. And lawyers work on probably 50 companies or something like that if they're good. That's probably more than a venture capitalist sits on in terms of boards, and it's certainly more than a particular founder can do. So there should be pattern recognition about how particular deals are structured.
Right.
There should absolutely be a familiarity on what's customary that you can, on commercial terms, not only financing terms or other things, that you can bring to bear. So all that stuff is something you should be able to bring in a law firm. Now, no one lawyer is the best, no one law firm is the best. And you've got to be able to sort of trust someone who can marshal the right resources internally in their firm or externally. And,
right.
Different horses for different courses. But that's what the job should be like, and it's why it's fun. There's a lot of different stuff you get to do.
Well, and I think it's that advice you get when, especially if you're a first-time CEO, and let's say someone comes knocking for an acquisition, and you've never been through an acquisition before. Like, I remember relying on Jim Brock in that case to, sort of shepherd us through that process. And here's what you need to worry about. Here's what to not worry about.
Sure. What's this idea of a personal rep? What's indemnification? Is it capped? Is it not? How big should an escrow be? How long should these reps and warranties last for? What should they say? What is this earn-out concept? What does that mean from a tax perspective?
Yeah,
all that stuff.
Yeah.
If you haven't done it before, it's absolutely daunting. And the most important thing, frankly, is to set you up so that you don't make a mistake, which prevents you from being able to get that deal done.
And same thing with on the financing front, right?
Totally.
I mean, you do a financing every day, and like first-time entrepreneur
Yeah.
might have done 3 in their life, right, or 0 more likely. And so just knowing, I remember talking with you about, hey Mitch, is this standard or not? No, that's way out of bounds, Joe. You need to pull that back. You need to be more over here, or why don't we go for that and let's see if they push back and we can trade that for something else.
It's a fun part of the job, right? And again, another important thing to think about is templates. And I think that the best partners for early stage entrepreneurs in terms of investors are much more thoughtful than they were 20 years ago when I started.
Yeah.
And in fact, 20 years ago, there's a really marked difference between East Coast and West Coast investors in terms of their view about the rights of investors and the benefits that capital should have in terms of being able to control the company.
Yeah.
West Coast, the West Coast model was much simpler, and it evolved to be much more pro founder. Over time, that erosion between, or that gulf between East and West Coast, it shrunk down. And the creation of venture capital, NVCA forums and other things have helped centralized it. And of course, all the information that's available through Quora and other places has really helped bound in the range of what's normal. And that's fabulous because you spend less time kind of arguing about things that are aberrational and more time kind of adding value on the margins. So I think that's a really an important part of what people can do. And I think that thinking about a template, what are you doing in terms of financing? What does that mean in terms of likely outcomes and what incentives does it create? It takes a while to understand that, and it's really not intuitive to a first-time, second-time, third-time entrepreneur. You got to do it a bunch.
Yep.
The other thing I'd say that's really important is all the mechanics around hiring and firing and issuing equity. The rules around valuations and the tax consequences of getting something wrong under 409A are markedly different than they were 20 years ago.
Yeah.
And similarly, the importance of thinking about how you classify employees, whether they're exempt or non-exempt, it's just been an area that has had increasing sophistication.
Yeah. Yeah.
And of course, all the terms of use and the commercial agreements matter pretty materially too. So there's lots of stuff, and it's none of it is, in my view, particularly counterintuitive, but there's so many details in it that it's important to make sure you're with someone who has done it before, and most important that they are not learning on your nickel as a lawyer, as a client.
Yeah, exactly. And I've had that situation as well. Not with Oric,
exactly,
or one of yours.
Damn straight.
One of your competitors, let's just say, and I ended up firing them, and they were really pissed off. I'm like, I forget what the question was. I think I asked about like founder vesting or something really simple.
What was standard?
And got like crickets back, and I'm like, okay, this isn't gonna work. Like,
yeah, that's not gonna work.
I should not know more about this topic than you should. You should know more about it. Anyway, well, why don't we see if we can help some people out?
Awesome.
So let's dive into some questions here. Once again, if you want to reach out to us, you can email us. The address is help@founderline.com, and you can also tweet to @founderline, and we'll see if we can help you out. So the first question is from Sean in Oakland. I am starting a company and trying to understand why someone would choose LLC versus a corporation. Can you please explain the pros and cons of both?
You bet.
And actually, it might be more than 2 here, but I'll let you handle this one.
Okay, let's start with that. And by the way, I'm not giving you legal advice.
We should definitely say that. Give
no
the disclaimer.
Yeah, we have no attorney-client relationship here, and I'm glad in generic to give my views on this. So
even though it feels like you know Mitch because I talk about him every week, he is not your attorney of record. He is my attorney of record. So
that is correct.
If I get in trouble during the show, you can offer advice.
I've got your back.
Okay, thank you.
Exactly right. So LLCs versus corporations. 2 things to note. The first is that the LLC is a fabulous, very flexible, brilliant creation that is highly susceptible to tailoring, and it's one of those things that folks who have creative minds love to play with. That said, and it has the benefit of, like an S corporation, which is a special type of corporation, allowing you to pass through taxes. The problem with the LLC is the following: one, most most investors don't like them and don't invest in them and choose instead to invest in Delaware C corporations. I'll get to that in a second. So while they're incredibly flexible, they're not common. They work in certain businesses. If you're not going to raise, for example, venture capital funding, it's a perfectly good mechanism. If you want to run a family business, if you're trying to do some sort of a business where you're going to have to think about distributions and avoid double taxation, it could be a perfect vehicle.
Like a consulting firm or
something like that.
Yeah.
It could be great. But if you're going out there, your plan is to raise seed money and venture capital financing, the corporate form and the C corporate form is the more standard. And part of the reason for that has nothing to do with the advantage of a C corporation or any form of corporation versus an LLC. It's just practice. Most of the people who are investing in them understand what their duties and obligations are under particularly Delaware law, though California law can sometimes apply. We'll get into that subtlety in a minute. But the truth of the matter is, folks who are writing checks are familiar with their obligations as investors. They're familiar with their obligations as shareholders. They're familiar with their obligations as directors under corporates, according to the corporate form. And as a result, they favor it. And because they favor it, people tend to create something in a format that investors find friendly and are familiar with. And so
Makes sense.
About 95% of the deals that I do are Delaware C Corps. Now, there's some question about whether you should be a California corporation or a Delaware corporation. If other folks have some questions about that, I can help. But bottom line, you can start as anything, as an LLC, as an S corp or a C corp. I bet if you're going to go the route of getting venture capital financing, you will end up as a Delaware C corporation somewhere along the line. And I think it's actually probably easier just to start right there.
And a lot of investors, as part of the financing, will say, well, we're going to switch you over to
totally.
Delaware, just for the good of all of us, right?
That's right.
And,
by the way, I'm always skeptical of advisors who have a strong, preference based on the law or anything else for one form or another, particularly if it's not a corporation. And the truth of the matter is, there are a lot more deals done with corporations, so there are many more forms around corporations. As a result, far less of the work is customized, and as a result, it's much cheaper. And it may well be that there's advantages to the flexibility of other vehicles. In fact, there are, but you pay for that advantage.
Yeah.
And it's a difference between a bespoke approach and buying something off the shelf. And a Delaware C corporation is a little bit like going to Gap and buying an extra large shirt. It's probably going to work just fine.
All right. So, Sean, I hope that helps. I definitely recommend, if you're getting started, just go Delaware C, and that's the easiest way to get going if you can.
But if you've got some unique about you're going to hold a bunch of assets, you're really thinking it's more like a partnership, you're going to be a consulting business, give somebody a buzz and they can walk you through the pros and cons.
Absolutely. All right. This next one is from Harry in Melbourne, Australia. So, hello to Australia. What are some common patterns you've observed in the successful founders you've met throughout your life?
That's a great question.
Other than they're completely crazy most of the time. So
actually, let's start with that. Founders who choose this path always have something unique about them, right? Most startups fail. It's not because they're bad ideas, but it's really hard to get that tech risk, that execution risk, the finance risk, and the market risk to all align. And so an overwhelming majority of these things will fail, and the people who are behind them will invest countless hours in them. They'll max out their credit cards to get this done. They'll work 80 hours a week absolutely tirelessly. They'll have enormous grit and resilience at dealing with setbacks. And it's one of the things that's fabulous about being a lawyer for startup companies is you get to work with people who are incredibly dedicated to what they're doing, right? They're doing important stuff, they're passionate about it, and they are absolutely going all out to make something successful. It's a fabulous privilege to work with folks who are totally dedicated to it. It means you're going to work hard and you're going to deal with people who are very emotional because they're investing everything in the success of this stuff. But that common trait of kind of having blinders about the fact that it's likely not going to work and working with absolute doggedness is a very common trait. And the best folks, I think, are both dogged and have enormous grit, but they're also pretty good at assessing realistically which risks are going to be ones they can overcome and which risks they are not going to be overcome. And I would say that it is common, and occasionally, you'll see this for everyone around the table, investors, founders, later employees, to forge ahead when something looks pretty hopeless. And and that's, I think, because of the quality and the force of the will of founders who refuse to give up and are going to try to make something happen. And I've been fortunate to see many companies over my career start with one direction and morph into another direction. And they didn't quite get it right in the first business model or the second, but boy, they might hit it on the third. And so that grit and determination is the single most important. I'd say another really important quality, though, of those who are truly successful is the ability to recognize of each of those risks, tech, execution, finance, and market risk, which ones they can handle and which ones they can't. And folks who can attract a really solid team to handle the risks that the founders aren't best at and can bring in others who are better able to knock those risks out, almost invariably are the most successful. And I think that while you have to have enormous grit and be able to sort of say, I can win something despite the long odds of this being successful, those who are able to figure out what risk they can't possibly reduce and bring in others, those guys and women are undoubtedly the best at what they do. So it's a team sport. This is not an individual event. And absolutely that you have to motivate and spread this same sort of infectious sense of passion. And I don't know a single startup, in my view, that hasn't had at least some meaningful setback. It happens. Some have fewer than others, but even those that are wildly successful undoubtedly have really tough calls and undoubtedly pivot a lot. And so I've never seen anyone who's rigidly, said plan A is what we're going to do. We're going to stick with the Schlieffen plan, and we're not going to depart from it. We know what we're doing. We're going to strengthen that flank, and you're not going to blink an eye. I've never seen that strategy work. Yep. I've seen people try it, but I've never seen it be successful.
All right, great. Well, Harry, I hope that answers your question. Let's go to a question from Michael in San Jose. This one is, you always hear about a startup that got tangled up fighting a frivolous lawsuit until they ran out of money. They can't raise money because of the lawsuit and end up settling or shutting down. What can be done to protect your startup from shakedowns like this?
I would say that in my honest experience, that doesn't happen that often. I've very rarely seen a startup be the victim of a frivolous lawsuit. I've seen a couple situations where very promising startups, in my view, have been targeted by larger companies with patent suits, which, while not frivolous, were, I think, in my view, designed to take the startups out while they were young and underfunded.
Yep. And
I think that's quite frustrating. But very rarely have I seen a random frivolous suit that's caused a company to fail. As a practical matter, most startup companies are pretty much not great, targets. They're not well capitalized.
Yeah.
So and that money disappears quickly. How long do they have money in the bank for? Maybe 12, 18 months until their next cycle. And so I just don't see an awful lot of litigation. And I'm fortunate for that, I think. So part of it is that they don't have a ton of money. Part of it is that I just don't think that you see a lot of litigation other than disputes around founders. And I'd say intra-founder disputes are a big problem.
Absolutely.
And that happens. People are working 80-hour weeks. They're very passionate. Some people want to turn left, others want to turn right. You can have some pretty big disagreements, and that pattern happens. So setting up a good governance structure to deal in advance with what are you going to do if we differ on something, making sure it's clear what the board and shareholder rights are, and sitting that clearly out in the documents, that's an important way at least to know that there's a way to resolve disputes, because disputes are going to come up. Another thing I'd say that's a pattern, a real problem, or a problematic pattern, is the phantom founder. And that's one thing that I would recommend every entrepreneur spend some time thinking about. By that, I mean somebody who originally came together. So Joe and I have an idea. We sit around, we think about it for a couple months. We get together on nights and weekends. We explore it. We both contribute in some way to the vision of what that's going to be. We work on the business plan. We both create some IP around it. Joe ultimately jumps, goes forward, makes it successful. I get cold feet. I stay behind at my day job, in this hypothetical, and I don't go along with them. 3 years of blood, sweat, and tears later, Joe creates a fabulous team, brings a fabulous product to market. He raises money successfully and ultimately sells the company for a lot of money after it's got broad adoption. Well, I'm kind of like, wait a minute, I played an important role in this too. I came up with some ideas. I was essential to the core business idea. I helped contribute IP, and I've got no equity. Yeah, I stayed behind, but I was an important contributor to the original business idea. I'm a founder too. That concept, in my hypothetical, that phantom founder person, really problematic. And so that pattern of someone being involved but not formally being involved, maybe in the formation of the company or its incorporation, but having some important role in creating the initial IP or the initial business idea is really an important one to pay attention to. The single biggest area where I see risk is that one, and making sure that when you form a company and seek advice from an attorney, you let him or her know that fact pattern is critical. Because it's often easy to deal with up front, but if you defer it, I guarantee you that the time you're successful, it will come back and be problematic. So I think that is the pattern I see the most challenge with.
All right, that's a good one. I wasn't aware of the phantom founder problem.
Phantom founder.
All right. Well, let's do one more before we go to thank our sponsors. This one is from Monica in Portland. Can you describe some of the ways that VCs protect themselves from things like down rounds and market crashes, and how that could impact early employees and founders?
Sure. That's
great question. Right?
Great question.
Especially in this market right now.
Yeah, it's a timely question, Monica. So there are a couple of things to think about. The first is there's a series of rights that allow venture capitalists or other investors typically to basically reprice around, and that is called anti-dilution. I won't get into the entire formula around it, but the concept of anti-dilution is if there is a subsequent issuance at a price below the price they paid, there's some form of adjustment which gives them effectively a new price for the shares they've issued. Or another way it might work is that they effectively just convert their old shares into a higher number of shares as if they paid a lower price. Okay. And there's 3 different formulas that are involved there. One called broad-based, one called ratchet, and one called narrow-based. The details on each of those don't much matter, but it's important as you actually get to the way, as you actually take an investment, to understand the differences between all 3. They can have a materially different impact on the founding team in terms of how they work. But that's one area of protection. So this concept of anti-dilution. There's a variety of other protections that they have. The most important of those are twofold. One, there's special rights that they have as shareholders, often called protective provisions. And protective provisions are ones which give investors, usually it's a majority of a series, we'll talk about that a little bit later, but it's the right to stop certain things from happening. So the next financing, a merger, a change in the business plan in a material way without the consent of that investing group. Okay? So a meaningful way that they can control through their vote as shareholders what the direction of the company is.
Yep.
Very helpful as a blocking mechanism to prevent the company from zigging when they want it to zag. There's also an entirely different set of protections around their right to sit on the board. Now, when you sit on the board, you've got a fiduciary duty to act in the best interest of all the shareholders, not in your own best interest as an individual shareholder. So if Joe were an investor in my company and we were board members and he had a particular interest as a shareholder, at the board level, he has a legal obligation to think about what's best for the shareholders as a whole, not just himself, and act in that way. But as a shareholder, Joe can vote in a way that's entirely in his best interest. The law makes that very clear. Fiduciary duty as a director, no such obligation as a shareholder. I guess there's actually a little bit of blurring in that. There is some case law that suggests that a certain, that sometimes very large shareholders can owe obligations to minority shareholders. But let's not get into that level of detail. At the highest level of abstraction, as a shareholder, you don't have to do that unless there are special circumstances. Yep. So most often it's through that concept of controlling the board, having the ability to block certain things as a shareholder, or having this concept of anti-dilution that you find investors being able to protect themselves in an unsettled environment. So, and by the way, I guess there's another protection which is not a legal one, but it's a practical one, which is the communities that we play in are small. Typically, if you go to seek an investment and say a B round, the B round investor is going to ask the A round investors, what do you think? And there's a practical situation. If I were a B round investor and I went to an A round investor, say Joe was our A round investor, and asked him what he thought about the investment, and Joe is negative on it, I'll move on. Probably just do something else. So separate and apart from that whole concept, it's a small community, and people tend to check with early investors about how they're doing.
And same is true. I always tell people, make sure you check references on your investors before you take their money, just to see what they're like when the chips are down or when you're struggling.
I'm surprised actually how rarely people check that, particularly at the angel level.
Yeah.
So it's enormously common, I think, to have a view of what the venture capital investor is like, and you can find information on that in Quora and elsewhere. But very few people actually check about angels, because I think it's a small investment that's really not that important. And yet, anybody who's a shareholder in your company has a lot of rights, and they can have a profound impact in the direction of your company. And I think that one of the more common mistakes that I see is people who don't pay attention and due diligence on those investors. You should think of any investor as someone who is going to be with you for a long journey.
Yep.
And I absolutely encourage you to think carefully about who those investors are, and not just will they provide money to me, and not just will they stand in the way, but actually do they have something that can add value and help reduce one of those 4 risks: tech, market, execution, or finance in a material way. And I would really encourage people, you can't always have this luxury, but if you do, think about those seats as like gold. Every time you're taking an investment, think of that as a real opportunity cost, where you're choosing someone over another person. And are they able to add something in terms of their skill set or their access to other capital that helps do something more than just taking money?
Yep, absolutely. And they also can be incredibly distracting.
Yeah.
The worst angel investor is the one who puts in a small amount of money, say 10K, and calls you every day, right? And you don't want that as part of your company. So.
No, you do not. And in addition, you also, there's a whole bunch of securities laws around who you should take money from.
Yes.
You should pay attention to that and know it. But further, you don't want to take a huge investment from somebody because, they can't afford to weather what is a risky investment. They have no business investing in your company.
Yep, makes sense. All right, well, let's take a moment here to thank our sponsors. And we wouldn't be able to do this show without the amazing support we get from our 4 sponsors: Oric, Square One Bank, Accretive Solutions, and Ustream. And normally I don't get to sit next to this guy and thank him, but I want to start out thanking Mitch and the entire team over at Oric. They've been with us since the beginning and have been staunch supporters throughout, which has really meant a lot to us. And I always tell people, when you're building a startup, of course you want a lawyer who can help you out with the legal paperwork, but more importantly, you want somebody who's going to be able to offer opinions about, hey, well, we've seen a bunch of these situations, and here's what typically happens in this sort of acquisition scenario or hiring scenario or financing or whatever it might be. They're going to have seen way more of those situations than you will ever see. And I know from personal experience what it's like to sort of have that in your back pocket and go, well, the acquiring company's asking for X, and Mitch will be like, that's crazy. Nobody ever gets that. I don't know why they're asking that. Just tell them no and they'll go away. And sure enough, most of the time they do. So it's an amazing resource to have. You want to have a great lawyer on your team who's helping you out. And I know these guys, and I've worked with them over multiple companies. They're the best. So go check them out if you want at their website. It is oric.com.
Hey, thanks, Joe. It's really nice to be here in person, and appreciate the kind words.
I say something like that almost every week. No problem
thanks.
at all. Thank you. So next we're going to move on to another sponsor, which is not Oric, which is Square One Bank. And I've been working with the team over there on a bunch of companies as well. Lori Lumenti-Gardi and Sam Baumick have been great supporters. And the same thing holds when you're choosing a bank. Of course, you want to make sure the money that your investors have given you is safe, that it's well taken care of. But you want a team who can help make your life a little bit easier. So things like online banking, maybe getting you a company credit card so that you're not putting a bunch of personal debt on your own personal credit card. And if something happens to the company down the road, you're stuck with $20,000 or $40,000 worth of debt. So the team over there can help you with a bunch of things like that will make your life easier. They're great to work with, and you should go check out more about them as well. Their website is squareonebank.com. Let's move on to our next sponsor, which is Accretive Solutions, and they are the leading business outsourcing firm in Silicon Valley. And this is a situation where they basically run your finance department for you. So when you're small and you can't afford to have a CFO and a controller and accountants who are doing all your accounts receivable, accounts payable, your payroll, getting your board packages together, all that sort of stuff, you can hire Accretive Solutions, and very cost effectively they can perform all those functions for you. As a CEO and a founder, you've got a ton of things that you should be focusing on: getting the product done, working with customers, hiring, recruiting, all that sort of stuff. And having a partner who can help you with that, sort of the basic blocking and tackling, making sure the books are correct and you know exactly what's going on in your financing and the basically the financial health of your company is critically important. You don't want to run out of money. That's the main thing that kills companies, is running out of cash. And so having them on your side and helping you throughout is really critical. And Martini Niganol is the woman who I've worked with there. She was my interim CFO at my previous company and is also for Founderline as well. And they just do a great job of making this stuff really simple and keeping everything up to date and making sure the books are clean. So check them out at their website. It is as-bos.com. And then finally, I'd like to thank Brad Hunstable and the team over at Ustream. They've been with us also since the beginning, and we're bringing you this show live over Ustream today. If you have a need for video streaming, maybe you have a company event that you want to broadcast, or maybe you want to do some sort of a webcast like we're doing today on a certain topic, their stuff is the best. So go check them out. You can find out more at their website, which is ustream.tv. So that is thanking our sponsors, and why don't we move on to some more questions. If you want to reach us, you can email us to help@founderline.com is the email address. You can also tweet to @Founderline. So let's see what we've got here. We've got one from Steve in San Francisco. This one says, there have been many stories of founder CEOs who have been replaced by so-called professional CEO. In your experience, what are the main reasons this happens, and how often does this work out for the company? So great question. Love to hear your thoughts.
Yeah, Steve, it is a great question. And I would say that in my experience, the most successful companies I've worked in about 20 years I've been doing this, have actually always had their founder CEO stay in place. And I think it's really hard for a professional to replicate that passion and the clarity of purpose and vision that the original team has. So generally, I think that the founding teams that have the core members still there tend to be the most successful companies. That said, they're more often than not, that's not the way it ends up. And I think that there are some venture funds that are particularly famous for having the view that it's better to bring in professional management, at some point, typically around the Series B or C stage, and that the skill set to get a company from formation to initial adoption is very different from getting it to profitability, which is very different to getting it to be a dominant player in a public marketplace. And It is true that they are very different skills. In order to find someone who can do all that, it's like finding a decathlete. They're good at enormous numbers of disciplines, And each of those events requires really different skills. And yet, I think that that when you find someone who's able to do that, and you think of the most iconic companies in Silicon Valley and throughout the world, they typically have the same folks involved. Larry Ellison's a great example.
Yeah.
Hard to imagine, where along the line someone else would have been involved. Now, the best founders typically supplement their skills at every one of those stages, in my view, with really skilled people who make up for their weakness at that level. And I've never seen a single team march along the entire way, because you need different skills at different times.
Yep.
But again, it's much more common, I think, to make a change. Now, there are reasons I think that changes happen that are not simply a nefarious scheme to replace a founder. Very often, in fact, I can count on one hand the number of times where I think there has been kind of a wrong decision to take somebody out. But I think that sometimes people burn out. This is a really hard job. It is stunningly taxing physically and mentally, and so some folks burn out and oftentimes decide it's time to let someone else try a couple rounds.
Yeah.
Oftentimes there's some tension in the founding team, and something's got to give. And frankly, sometimes the ability to find a manager who's able to deal with the executive function is easier than finding the technologist who are trying to solve a particular technical problem.
Yeah.
That's absolutely true. Another common theme, frankly, is that there's been some fundamental change in the marketplace which requires the company to pivot in a 180-degree direction. So the vision the founders had is very different from the path that seems like the best one, and the skills the founders have are very different from the ones that others bring to bear. And so it's a sensible move. And most often the founders, in my experience, are on board with that change because they recognize that one of those roadblocks has occurred. They've invested a lot of time, effort, energy. They've got stock in the company. They want to see it be successful. So it's actually not that often that you find a contentious shift. Now, that said, I still think, in my experience, the companies I look back on as most successful, start to finish, have the same team involved.
Yep. And some venture firms like Andreessen Horowitz is known for being very founder, CEO friendly, right?
Yep.
And if that person isn't the right person, let's get them the resources to be successful.
That's right.
And I think that's actually one of their big draws in terms of founders wanting to work with them.
I think it's been a very successful part of their marketing and the community. And I tend to agree that if you can support the existing founding team and supplement their skills, it's probably the best outcome.
Yeah. All right. Well, Steve, hope that answers your question. Let's go on to Nick in Redwood City. How do you decide which companies to work with or not work with? Is that decided by the individual lawyer or some sort of committee? So great question, and maybe it varies by firm. So why don't you talk a little bit about how you guys handle it?
So I've been at different firms where we've had different approaches. I've been at Oracle for about a decade, and it's up to the individual partner, by and large. I'll just answer the question as to how I deal with it. Life is finite, and you want to, I think, recognize you can't do everything. And so I try hard to think about industries where I'm passionate and have some experiences as the right one. So I personally don't do anything in the life sciences area. Several of my partners do. I don't know that investing community well, don't know enough about the problems that are there, and I just don't work in that area. Occasionally I'll get something started, but I'll often find a better home, with a lawyer that's better suited. So for me, the first important thing is, do I know the sector well? Second is, and this is one of the benefits of having done this for a while, I really I value the relationships with repeat entrepreneurs. It's one of the things that I really care deeply about. You go through challenging times together. You develop a reservoir of goodwill and trust and respect for people like Joe that you've worked with before. And as a result of that, it's much more rewarding to work with a repeat entrepreneur, in my view, than it is to work with folks you don't know as well. You've got a shorthand, and you've developed a trust with one another, and you have a common experience that you can draw on and talk about. Well, last time X happened, and let's try to avoid X, and let's see if a different mistake will be the one that we make this time. So
that would never happen.
It would never happen.
Yes.
But, that to me is an important criteria. Now, That said, everyone's got their own mix of what they want to do, and there are certain ideas that you're just really passionate about, and you love the excitement and enthusiasm of a great entrepreneur, and just like working with them. So for me, the entrepreneurs are more important than the technology or the market, and the personal connection with founders are the most important thing. For a lot of my colleagues, the tech's the most important thing, and for others still, the particular vertical is the most important thing. So it all depends on what motivates a particular lawyer. But for me, it's really about the people who are involved. That's what gets me out of bed. It's a very personal connection, and I like to work with people that I like, and try hard not to work with people I don't.
I think those are some words to live by there. So we have about 10 minutes left. Let's see if we can get a few of these in. We got a bunch of questions here. So this one's from Matt in San Mateo. I'm forming a new company, and I'm thinking about how I should set up the company in a number of important items like employee vesting schedules, early exercise, and acceleration upon acquisition. Can you talk about the most important items to worry about when setting up a company, and what's typical for those items? So what do you think?
Yeah, sure. Again, not providing legal advice, but let me make sure that at a high level I kind of go through those.
Yeah.
So the first thing to think about as you're forming a company is you're creating a template for everyone that's going to follow after you.
Yep.
And for the 20 years that I've been in the Valley, I think that it has been quite customary for there to be 4-year vesting. Almost always it's 4-year vesting with a 1-year cliff. One of my good friends, Jason Lemkin, former guest of Founderline, a VC at Storm, successful entrepreneur, I think he tweeted sometime in the last 3 months suggesting that a 5-year vest was more appropriate as companies stay private much longer than they traditionally did. And a model that developed in the 1990s, when companies would typically go public after 4 years, doesn't make as much sense in 2015, where we're seeing very successful companies staying private for much, much longer. And back in the 1990s, there was much less of an opportunity to get founder liquidity at various times. So I actually think Lemkin's onto something thoughtful there. Now, the important thing to think about is what template are you setting for the rest of the employees to follow? And many times founders will try to have a 3-year vest as opposed to a 4-year vest for folks who come later. I'm a big fan actually of trying to create a template which works for everybody. I think that founders deserve credit for vesting starting back when they came up with their idea, assuming that they came up with that idea when they were free from any encumbrance with a prior employer. And that's an important point that you should consult with a lawyer about. But I think that in general, setting up a 4-year vest is more normal. That's the first thing I'd say. Secondly, I think that the concept of acceleration upon a change of control is often misunderstood. The concept of there are two ways to look at that. There's the concept of single trigger, meaning what acceleration happens if you get acquired, or double trigger, what happens if you're terminated without cause following a change of control.
Yeah.
And I'm a big believer that founding teams should have generous provisions around acceleration on a change of control if you're terminated without cause, or the double trigger. The reason for that is because it doesn't really cost the investors anything to give up that protection, because those shares are already part of what an acquirer is paying for, and you're merely protecting someone in a case in which they're terminated without cause, which seems just to me.
Yeah.
And so I tend to be very aggressive and suggest that 100% double trigger is completely appropriate. I think that it is not customary for that to be the case, but I think it makes complete logical sense, and I love talking with investors and their counsel who don't think it does, to try to explain why I think that that's an irrational view. Another thing I think that's really important to think about as you think about setting up a company is more important than what the vesting is or what acceleration you have is what's the right mix relative to the founding team.
Yeah.
There's an awful lot of art there, and more art than science, perhaps. And I think that rather than go into a detailed analysis of what I think is customary or how to even go about that, it'll take longer than the time we have left. I think there are two things to think about. One is a sense of what's customary in the marketplace, and if you were to go out, what would it cost to hire somebody to fill that skill set if it wasn't you?
Right.
And the second is, regardless of what's customary, what feels fair to a founding team? And I've seen many great founding teams depart from what's customary and say, we know that person X skill set is more highly sought after, and therefore traditionally the person in that role would have more shares. But we feel pretty compelled that we should split it differently because of a sense of fundamental fairness amongst us. And in my view, I tend to think that getting that latter right is more important than getting the former right, because ultimately it's a relationship of trust. You're going to go through some bumps, and doing what you think is fair as opposed to what's customary is how I would err. Now, that said, I think there are plenty of times where venture capitalists and other investors will come in and say, hey, we've looked at your cap, the way you allocated the cap amongst the founding team doesn't look right to us, and we'd like you to reshuffle it. That absolutely happens. I think it happens in less than 10% of the companies I've worked with, but it might happen. But I really think that as between what's customary and what you think is fair, follow your heart in terms of what you think is fair.
All right.
Hopefully that's helpful.
Great advice. Let's go to Dennis in San Francisco. We have 3 founders and split the company evenly amongst us. Unfortunately, one of the founders isn't participating nearly as much as the other 2 of us. What are our options? So maybe this is less of a legal question and more of a operating question. But what are some of the things they might possibly do? I mean, firing them is obviously one of them, but
yeah, obviously talking about it is a good way to start.
Yeah,
I think being upfront, honest about it, and describing why you feel that way, probably the best way to operate. Hopefully, you've incorporated this thing and created vesting. So that you know what your rights are. Hopefully you talked to a lawyer about it and you got a template that makes some sense. But absolutely, start by talking about it. I would say that probably half the time where 2 founders feel that way, the third founder doesn't have a clue about it. And it might be that person's a freeloader who's just trying to be a slacker and drift off of everyone else's hard work. But I think very often they just might have different expectations, and a good discussion about it might help. Yep. By the way, it's one of the reasons that I typically like one-year cliffs in founding arrangements, and it's because A, it forces people to work through issues if they have problems,
right?
And B, if it doesn't work out, it's kind of no harm, no foul. And so I tend to like cliffs and advise the clients I work with generally to put cliffs in place.
All right. Well, we've got time for one more, I think.
By the way, be careful if that person leaves to make sure that you get the documents well done and you don't have a phantom founder.
Back to our earlier point. So this one is from Danny in Half Moon Bay. It seems that the 3 possible funding mechanisms are equity, convertible debt, and the YC safe. Can you talk about why you might choose one over the other? What would be the legal costs associated with each? So we've only got about 2 minutes. So maybe give us the 50,000-foot view on those 3.
All 3 are great. All 3 make sense at different times. The YC Safe is something that my partner John Batista played a pretty critical role in developing. Those documents work well. I think they're smart, and I like them, and they're pretty cost effective. Convertible debt traditionally was cheaper than equity and had the benefit of being very quick to put together, cost a couple $1,000 to do a deal and be thoughtful about it. The biggest problem with convertible debt is to think through what happens if you get acquired prior to an equity raise, and how do you treat people in that situation so that you contemplate that. And similarly, what happens if you don't raise equity, what rights do you have? But the biggest problem is if you're successful prior to the equity raise and all the documents are only based assuming you're going to convert to equity, what do you do in that situation? So pay attention to that issue. There's more and more pressure, I think, to do full-blown equity documents. The forms have gotten a lot better. It's a lot cheaper to do those. I would say that in general, there's been a move away from convertible debt more toward the safe documents or actually equity. But I still tend to like convertible debt deals, often with a cap. I just think that they're incredibly cheap and efficient to do, and I like them. Oftentimes you'll find people moving when they do equity deals to doing light equity deals with watered down rights, preferences, and privileges. Those are fine. And again, all these documents are templates. It shouldn't cost more than a few $1,000s to do it. The complication comes from multiple investors having multiple lawyers involved. The single best way to keep costs down is to make sure there's one point person speaking for all those investors, if you can, and it's someone experienced. The worst is you've got, Uncle Art is a real estate lawyer from, Cleveland, and he's going to help look at the documents for me.
Right.
That is the single best way to screw up a company and to raise cost. When you get someone who thinks they know what's going on and they come in there and monkey with the documents and start to play around with them, it becomes very inefficient. So encourage all the investors to use one lawyer who's going to look at it on their behalf. Make sure it's someone who knows the art and who's familiar with all three of those forms. And all three of them work in the right place. But my personal preference, I like convertible debt with a cap these days.
Oh, all right. I'm surprised by that answer, but I like it. We might have to talk about that later.
Exactly.
So unfortunately, we're out of time, but awesome answers. So thank
Awesome
you
to
for
see
taking
you,
the
Joe.
time. Great job today. And if you would like to follow Mitch on Twitter, you can check him out. His Twitter handle is @MitchZukli, and you can also find the company at Oric as well.
You can also just drop me an email at mzukli, MZUKLIE, @oric.com.
Well, there you go. Let's see if he gets any emails. Tune in next week for another episode of Founderline. Our guest will be Chamath Palihapitiya, and I can't believe I got that right, who's the founder and managing partner of the Social Capital Partnership based in Palo Alto. Chamath was instrumental to the growth of Facebook and is one of the owners of the world champion Golden State Warriors. Go Warriors, new season. It's going to be a great show. He's known for being slightly controversial when he's on air. So get those questions started, send them in early, and we'll be sure to get them on the air. It's next Wednesday, October 7th at 5 o'clock Pacific time. Thank you once again to our fantastic sponsors, Oric, Square One Bank, Accretive Solutions, and Ustream. Don't forget to follow us on Twitter. Our handle is @Founderline. You can send us questions in advance at help@founderline.com. You can go to our website where you can see upcoming guests. You can read more about previous episodes, and you can also subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next time.